let's start right now with a really quick Q&A. We'll take 7 to 10 minutes, some quick questions.
From an emerging market perspective, I'm somewhat nervous about investing in, my preference is to invest in North American or European companies that do most of their business overseas in terms of a particular, from an equity perspective. I have some concerns from an Indian perspective about the issues of growth rates and inflation. So I'm not sure I would look at that as a specific approach that we would take. I should mention that we don't actually typically invest in countries. We focus on investing in companies, which may or may not be resident in any particular jurisdiction. So I don't know what the growth rate in India is likely to be, but my guess is it's going to be lower than that of China, and that's likely to be shrinking over the next 2 or 3 years. Any thoughts?
No, what I would say that what we do for global equities is we give our managers a global mandate so they can invest in the best countries anywhere in the world. And if they find them in India, that's great. If they find them in China or Europe, that's fine as well. So, as far as our specific view on India, to be quite honest, it's not something we spend a lot of time looking at. We would really leave and defer that to our global equity managers.
It's not impossible. All of the private equity managers do quarterly reporting to their investors and do their best with their auditors to come up with what they define as a net asset value. The issue is it's not as difficult to come up with a value as to come up with a way that you can allow people to redeem or get their cash or their equity out prior to there actually being a sale of all of the businesses in the fund. So one of the objectives that we have is by using a fund-to-fund approach and by keeping a certain amount of the funds available in different kinds of liquidity, is that after a 3-year holding period, clients will be able to actually redeem without having to wait for all of the individual private equity investments within the pools to have actually matured.
There is a very strong correlation with the Canadian dollar and oil. So I would ask, where do we see oil going? And right now, oil has been moving higher. A lot of that's based on what's happening in Iran. If that were to go away, I would suspect that perhaps you would see short-term oil come down and the Canadian dollar would come down. I think that from if you look at purchasing power parity, the Canadian dollar is overvalued, and you can see the impact it's having on manufacturing in Ontario. So that's one of the reasons why the Bank of Canada doesn't want to increase interest rates here, because the Canadian dollar would even go even higher. So I mean, it's short term, it's always hard to tell what's going to happen with currencies, but that would be my sort of judge, is that the Canadian dollar is a little bit high when it gets over parity. As far as the U.S. dollar, I mean, it's compared to what? And as bond guru Bill Gross comments, the U.S. is the least dirty shirt in the world right now, which means that when you look at other countries and their problems, the U.S. actually looks not bad, and that's why it's being still perceived to be a safe haven currency. So if you get more turmoil in Europe, if you get the threat of problems in China, more money is going to come into the U.S. dollar, and the U.S. dollar would continue to go up.
Yeah, and just to add to that, I think that as Canadians, typically we still have 80 or 90% of our money invested in Canada, and our dollar has appreciated not just actually, obviously against the U.S. dollar, but against other currencies as well. It just makes sense when our dollar's at this level to start seriously looking at buying the assets that are available in other countries. It's a bit of a shopping expedition, and the U.S. in particular intrigues me because while the U.S., as Rob points out, has massive deficit issues and complete political gridlock, the reality is they have a much lower tax burden than Europe. I mean, if the U.S. put in a national sales tax like our GST tomorrow of 7 or 8%, they wouldn't have a deficit at all, and they'd still have a lower tax burden than Canada and much lower than any European country. So the U.S. has a huge deficit issue, but it has one it can actually solve. And a lot of other countries, and I would include Japan and many European countries, don't have anything like the luxury of that. And that's a big difference in terms of the future opportunity. So at some point, the crisis in the U.S. will cause the U.S. gridlock to end, and there will be a resolution to eliminating their deficit. It's unfortunate that it may come to it having to be a crisis before that occurs.
And on that, I'm just going to make one comment because John was a little hard on gold. So I'm going to say, you know, there is a good way this could all work out, and there's a bad way. And the bad way is if you are not able to get your deficit under control and you end up having to try to inflate your way out of it. This is a scenario that could play out. And in that scenario, gold will keep its purchasing power, whereas other stocks and bonds won't. And that's the case for gold in a portfolio, and that's the insurance policy that you want.
My sense of the survey is that they're looking for complete integrated immigration. The problem is we don't have a system that would actually allow them to come in at the rate that they might want to come in. So the issue will probably be far more political than anything else. I think the capital would come in here. It probably would provide a floor for what could otherwise be a house price correction that would occur in Vancouver. My guess is politically it will only be allowed to occur at a relatively modest pace. So there will always be this wait list of potential wealthy immigrants looking to come in, and they'll just simply have to get in line. And so I'm still of the belief that the Vancouver housing market in particular is the most vulnerable one in Canada.